You're watching something most people won't notice until it's already too late. A few hours ago, deep in the plumbing of global finance, something shifted. Not in the stock market, where everyone's eyes usually go. Not in crypto, where the drama plays out loud in public. But in Japan's government bond market, the place where trillions of dollars of assumptions live, the place that's supposed to be boring, predictable, safe. And when I say something shifted, I don't mean a bad trading day. I mean the kind of movement that makes risk managers wake up at 3 a.m. and start running numbers they hoped they'd never have to run. While financial media was doing its usual thing, recycling the same narratives about stock momentum and Fed policy, the long end of Japan's yield curve started behaving in a way that suggests the rules might be changing. And here's the part that should make you pay attention. When a major bond market starts moving like this, it doesn't stay contained. It leaks into currencies, then into other bond markets, then into anything priced off the assumption that borrowing costs stay manageable forever, which, if you look around, is basically everything. So let's talk about what actually happened, why it matters beyond Japan, and what it might mean for markets that seem completely unrelated, like silver, which just made fresh highs while most people weren't watching. Because the connection between a bond crisis in Tokyo and a metal most people associate with coins and jewelry is more direct than you'd think. And understanding that connection might be the difference between seeing what's coming and being surprised when it arrives. Here's something most people don't realize. The global financial system doesn't run on stocks or currencies or even central bank policy, really. It runs on confidence in government debt. Specifically, the confidence that when a major government issues a bond, you can buy it, hold it, sell it, and trust that the price won't explode in your face. Government bonds are the collateral underneath almost everything else. Banks use them to secure short-term funding. Insurance companies hold them to match their long-term liabilities. Pension funds buy them because regulators say they're safe. Foreign governments hold them as reserves. The entire architecture of modern finance is built on the assumption that sovereign debt from major economies is basically solid ground. Japan's bond market is one of the pillars of that architecture. Not because Japan is the biggest economy anymore, but because Japan has been the living proof that a developed country can run enormous debt loads without the system falling apart. For 3 decades, Japan has been the example everyone points to when they want to argue that deficits don't matter, that central banks can control yields indefinitely, that the old rules about debt and inflation were just conservative paranoia. And maybe they were right. For 30 years, they were right. But what happened in the last few trading sessions suggests that maybe the experiment is entering a different phase. The kind of phase where the market starts testing whether the promises can actually be kept. Let me give you the numbers, because the numbers tell you where the stress is. Japan's 30-year bond yield jumped in a way that doesn't happen during normal market functioning. Not a smooth rise because of good economic news, a spike. The kind of move that suggests someone, somewhere, had to sell in size and couldn't find enough buyers at the old price. The kind of move that makes the people who manage risk for a living start asking uncomfortable questions about what happens next. Now, you might be thinking, okay, yields went up, so what? Isn't that just normal volatility? And in isolation, maybe. But you have to understand what Japan's debt situation actually looks like. Japan's government debt is over 200% of GDP. That's not a typo. For every dollar of economic output Japan produces in a year, the government owes more than $2. And that debt has to be rolled over constantly. Old bonds mature, new bonds get issued, and the whole system depends on finding buyers willing to lend at rates the government can afford to pay. When rates were near zero, that was manageable. Uncomfortable, but manageable. You issue new debt at 1% or less, you pay it back over decades, and inflation quietly erodes the real value over time. It's not pretty, but it works. The math holds. But when yields start rising, especially on the long end, the math changes fast, because long-term bonds are extremely sensitive to rate changes. A small move in yield creates a large move in price, which means anyone holding those bonds just watch their portfolio lose value, which means their risk models start flashing red, which means they have to do something. And what they usually do is sell. Here's where it gets interesting. Most of Japan's government bonds are held domestically. Pension funds, insurance companies, banks. These aren't speculators. These are institutions that bought Japanese government bonds because they were told it was the prudent thing to do. Safe, liquid, backed by a major government with its own currency and central bank. And for a long time, that was true. The Bank of Japan acted as the buyer of last resort. And whenever the market wobbled, the central bank stepped in and bought bonds to keep yields stable. It was an implicit promise. We won't let this market break. But promises in finance are only as good as the math underneath them. And the math is starting to look strained. When yields spike, these domestic institutions don't just feel it theoretically. They feel it on their balance sheets. Bond prices fall, capital ratios get squeezed. risk committees start asking questions. And once risk committees start asking questions, portfolio managers stop being strategic and start being tactical. They reduce exposure. They cut positions. They sell what they can sell. And here's the feedback loop. When everyone sells the same thing at the same time, liquidity disappears. Bid-ask spreads widen, prices gap, and suddenly the safe asset doesn't feel so safe anymore, because the one thing government bonds are supposed to be, besides stable, is liquid. You're supposed to be able to sell them easily without moving the market. That's half the point. When that liquidity vanishes, you're not just looking at a bond market problem. You're looking at a collateral problem. Because those bonds are sitting in repo agreements, in margin accounts, and reserve calculations, everywhere. If their value is uncertain, if their liquidity is questionable, then the whole system has to reprice risk. And repricing risk is the polite financial term for panic. Now, let's talk about auctions for a second, because this is where theory meets reality. A bond auction is the market's real-time vote. The government says we need to borrow this much money at this maturity. Who wants to lend? And investors either show up or they don't. When they show up in force, yields stay manageable. When they hesitate, yields rise to compensate. When they don't show up at all, you get a failed auction, which is the financial equivalent of your credit card getting declined at dinner. Japan hasn't had a failed auction, but the quality of recent auctions has been deteriorating. Weaker demand, higher yields required to clear, dealers getting stuck with inventory they don't want. These are warning signs. Not a crisis, but the conditions that precede one. Because here's the thing about sovereign debt crises. They don't announce themselves with a press release. They build quietly in auction rooms and risk committees and hedge fund meetings until one day the pressure is too much and something snaps. And by the time it's obvious to everyone, it's too late to get out cleanly. Now let's connect this to something that matters beyond Japan, the carry trade. For the last 20 years, Japan's low interest rates have been a gift to global leverage. Here's how it works. You borrow money in yen at near zero rates. You convert that yen into dollars or euros or whatever. You invest in higher yielding assets, stocks, bonds, real estate, emerging markets. You pocket the difference between what you earn and what you pay in interest. It's free money as long as two things stay true. Rates in Japan stay low and the yen doesn't strengthen too much. When those two things are true, the carry trade is a printing press. Hedge funds do it. Banks do it. Corporations do it. It's one of the quiet engines of global asset prices. All that cheap yen funding flowing into risk assets, pushing prices higher, making everything feel more liquid and more valuable than it might otherwise be. But carry trades have a nasty habit of unwinding violently when the assumptions break. If Japanese yields rise, borrowing in yen gets more expensive. If the yen strengthens, your investment loses value when you convert back. Either one is uncomfortable. Both at the same time is a disaster, because suddenly the math that made the trade attractive reverses. You're losing money on both ends, and when that happens, the only rational thing to do is close the trade. Sell the assets you bought, buy back the yen you borrowed, and get out. Which means selling. A lot of selling. Across asset classes, across geographies, not because anything fundamentally changed about those assets, but because the funding mechanism broke. And that's how a bond market problem in Japan can turn into a liquidity crisis in New York or London or Sao Paulo. It's all connected. The leverage is global. The funding is global. And when funding conditions change, the effects spread. Let's make this concrete with US Treasuries, because this is where the mechanics get really uncomfortable. Japan is one of the largest foreign holders of US government debt, over $1 trillion worth. They hold it for reserves, for currency management, for portfolio diversification. It's a core part of how Japan manages its financial system. But here's the problem. If Japan's own bond market is under stress, Japanese institutions face a choice. They can defend their domestic bond market by buying Japanese government bonds, or they can defend the yen by selling foreign assets, including treasuries, and using the proceeds to buy yen. Both options have consequences. If they defend bonds and let the yen weaken, inflation pressures build, imported goods get more expensive, energy costs rise, the population feels it, politicians feel pressure, and a weak currency, if it goes too far, can start a different kind of crisis. If they defend the yen by selling treasuries, US bond yields rise, which affects mortgage rates, which affects corporate borrowing costs, which affects the refinancing of US government debt, which is also enormous and growing. The US is running trillion-dollar deficits. Higher rates mean higher debt service, which means bigger deficits, which means more borrowing. It's a loop. So Japan's problem becomes America's problem, not because of any conspiracy, just because of the math. The two bond markets are linked through reserves, through currency management, through the web of global capital flows. And when one pillar starts to crack, the whole structure feels it. Now you might be thinking, won't central banks just step in and fix this? Won't the Bank of Japan buy more bonds? Won't the Fed do something if Treasury yields spike? Maybe. Probably, even. But every time a central bank intervenes to cap yields, it's telling the market something. It's saying that rates cannot be allowed to rise naturally, which is another way of saying that the debt load is too large to service at market rates, which is another way of saying the only way out is to keep creating money. And that brings us to why any of this matters if you're not a bond trader. Silver made fresh highs this week, not a slow grind, a spike. The kind of move that suggests something changed in the way people are thinking about risk. Now, you could explain silver's move through industrial demand, solar panels, electronics, 5G infrastructure, all real, all growing. But industrial demand doesn't usually create spikes. It creates steady trends, predictable growth. This was different. This had the signature of monetary demand, the kind of buying that happens when people start questioning whether the paper promises will hold. Here's the connection. When bond markets signal stress, when yields rise because of risk premiums rather than growth, people start looking for assets that don't depend on someone else keeping a promise. Gold is the obvious one. It's been money for thousands of years. Central banks hold it. It has no counterparty risk. You own it, it's yours. And it doesn't matter if a government or a bank or a currency fails. Silver is gold's volatile younger sibling. It has the same monetary properties, but it's a smaller market, less liquidity, more industrial use, which means when monetary demand shows up, it moves harder and faster. The spikes are sharper, the drawdowns are deeper. But the fundamental appeal is similar. It's real, it's scarce, and it's not anyone's liability. When bond markets start behaving erratically, when yields spike in ways that suggest forced selling rather than rational pricing, metals respond. Not because of any mystical property, but because people start asking a very simple question. If bonds aren't safe, if currencies might be debased to manage debt, if the whole system depends on central banks printing to hold things together, then what actually holds value? And for a lot of people, throughout history, the answer has been metal. Now here's something most people miss. There's a difference between the price of silver on a screen and the price you actually pay to take delivery of physical metal. In calm times, those prices are close. Maybe a small premium for fabrication, shipping, dealer markup, normal business costs. But in stressed times, they diverge, because paper markets can create supply with a keystroke. Write a futures contract, sell a derivative. It's just numbers on a screen. But physical metal has to be mined, refined, fabricated, shipped, stored. It has real-world constraints. When demand surges, physical markets tighten. Premiums rise, delivery times stretch, dealers run low on inventory. And suddenly, the paper price and the physical reality don't match. You see spot trading at one number, while actual metal, if you can find it, costs significantly more. This isn't a conspiracy. It's just market structure. Paper markets are fast and liquid. Physical markets are slow and constrained. And when stress hits, the difference becomes visible. If you're watching silver and thinking about what it means, this is the indicator that matters. Not just the spot price, but the premiums, the delivery delays, the availability. Because those tell you whether the move is speculative or whether real demand is underneath. And lately, the signals suggest real demand. Let's talk about how a price squeeze actually works, because it's not random violence. It's mechanics. A squeeze happens when positioning is wrong and price moves against it. In silver, there are always players who are short. They've sold contracts they don't own, betting the price will fall, planning to buy back cheaper later. It's a normal part of market making and hedging. Nothing nefarious about it. But if price starts rising instead of falling, shorts start losing money. At some point, the pain gets too much and they have to cover, which means buying, which pushes price higher, which forces more shorts to cover, which pushes price higher again. It's a feedback loop. Silver is particularly vulnerable to this because the paper market is huge relative to the physical market. You can trade multiples of global annual production in derivatives without ever touching real metal, which means you can build up large short positions that look manageable until suddenly they're not. If stress in bond markets drives monetary demand into silver, and that demand pushes price through key levels, and those levels force shorts to cover, you can get a move that feels disproportionate to any fundamental news. Because it's not driven by fundamentals at that point, it's driven by positioning and forced buying. This is why round numbers matter psychologically. They become reference points. Below 100, it's one story. Above 100, it's a different story. Media notices, algorithms trigger, momentum strategies engage, and suddenly, the market isn't trading what silver is worth. It's trading what happens when everyone has to react at once. Now let's zoom out to something most people never think about. Collateral. The financial system runs on collateral. Banks borrow short-term and repo markets by posting collateral, usually government bonds. Hedge funds get leverage by posting collateral to prime brokers, usually government bonds. Derivatives. Positions require margin, usually satisfied with government bonds. Government bonds are treated as pristine collateral, the safest thing you can post, which means you can borrow more against them. The haircut is small, the leverage is large, but what happens when government bonds stop being stable? When yields spike and prices fall and volatility rises, suddenly that collateral isn't as good. The haircut increases. The amount you can borrow decreases. You have to post more collateral or reduce your positions. And when everyone has to reduce positions at the same time, you get forced selling. Not because anyone wants to sell, but because the math requires it. Collateral values fell, leverage limits tightened, positions have to shrink. This is how a bond market problem becomes a liquidity problem. It's not that the assets people own suddenly became worthless. It's that the funding mechanism underneath those assets stopped working smoothly. And in modern finance, funding is everything. When funding seizes up, correlations break. Things that normally don't move together, move together. Because it's not about fundamentals anymore, it's about who has to raise cash and what they can sell to raise it. Gold goes up while stocks go down, while bonds go down, then everything reverses the next day. It looks irrational on a chart. But it's perfectly rational if you understand it's a scramble for liquidity, not a vote on fair value. Let's think through how this could play out, because that's more useful than pretending we know for certain. Scenario 1. Japan stabilizes. The Bank of Japan steps in aggressively, buys enough bonds to calm the market, yields retreat, and the yen holds relatively steady. This is the soft landing. It requires perfect timing and a market that's still willing to believe in central bank credibility. It's possible. Central banks have pulled off rescues before, but it has a cost. Every time you intervene to cap yields, you're adding to the money supply. You're telling the market that inflation will be tolerated rather than default. And over time, that supports the case for real assets. Scenario 2. Japan stabilizes yields, but the yen weakens sharply. This is the we saved the bond market but sacrificed the currency outcome. It tends to be bullish for precious metals because the signal is clear. Debts will be paid, but the currency will be worth less. If you're holding yen-denominated bonds, your nominal value is fine, but your purchasing power is eroding. This scenario often plays out slowly enough that people don't panic, but fast enough that reality sets in. Imported inflation rises, living standards decline, and people start looking for stores of value that don't depend on currency stability. Scenario 3. Japan can't stabilize yields. The long end keeps running. Auctions struggle, the market starts behaving like it doesn't believe the promises anymore. This is the market revolt scenario. It forces emergency measures, currency intervention, capital controls, coordinated central bank action. And it creates spillover stress everywhere because the assumptions that held the system together are breaking visibly. In all three scenarios, faith in paper promises weakens to some degree. The only question is how fast and how far? Nobody knows. Anyone who tells you they know is lying or deluded, but we can watch for signals. We can see which scenario the market is pricing, and we can understand what different outcomes might mean. If you see yields retreat quickly without massive central bank intervention, that's stabilization. The market found a level and confidence held. That's the least chaotic path. If you see yields retreat only after the Bank of Japan goes all in, that's intervention. It works, but it confirms the system can't function without support. That's the slow debasement path. If you see yields keep climbing despite intervention attempts, that's loss of control. And that's when things get genuinely unpredictable because the market is openly challenging the central bank's ability to manage the situation. Silver will tell you which path we're on, not because silver knows the future, but because silver responds to stress and confidence. If yields spike, central banks respond with liquidity, and silver continues grinding higher, that's the market saying we see where this goes and we don't trust the currency solution. If yields stabilize and silver pulls back hard, that's the market saying false alarm, the system held, we can go back to normal assumptions. But if yields spike, interventions fail to hold, and silver goes parabolic, that's different. That's the market saying something fundamental broke, and we need to reprice everything.